Jennifer, what are the main lessons for 2020?
About logistic real estate, what can be observed in Europe for this year in terms of capital values and rents is that the crisis has not had a strong negative impact. The upward trend observed in the past has continued, but the pace of growth has sharply decelerated in H1 20 before recovering in H2 20. If we look at the European panel in Marseille, Lyon, Düsseldorf, Madrid, and Barcelona, capital values have maintained the same growth rate as their 5 years average. This doesn't surprise us, given the current tension between supply and demand in most of both markets. Yields have dropped massively, but this is largely due to the resiliency in vacancy rates. Logistic will continue to benefit from the current shortage in supply and would favor the asset class in areas such as Lyon, Marseille, Milan, and Barcelona. Do you want to add something, Etienne?
Yes, thanks, Jennifer. More than the other asset class, the increase in capital value is driven by the sharp drop of the investment yield. Today, we see some logistics assets secured by long-term cash flow trading at yields pretty close to the ones of core office buildings. To be honest, the fact that there is no more premium versus office properties, which is an asset class with a much longer economic life, challenges us as a lender. It is probably the result of the investment market anticipating an important growth in the rental values. But for us, it doesn't seem that obvious, notably for the following reasons. The first one is that logistics business is a very competitive one, with small margins, which puts pressure on operating costs, and real estate is an important one. Second one is that logistics is in full transformation, and the operators will have to invest heavily in new technologies to gain in performance and productivity. Not sure that at the same time, they will also be able to support a strong rent increase. At last, even though sales in e-commerce is anticipated to grow fast, and customers in cities are increasingly demanding in search for even more efficient service, but of course, without wanting to pay more. As a consequence, for the time being, we remain cautious on this asset class, and we are more keen to finance investors seeking for low debt leverage.
Yes, you're right, Etienne, and this view is reinforced if we look at cross-border investment in logistics in Europe. The decline is quite small compared to other sectors, only 8% decrease since the beginning of the year, due to the structural factors that have supported this asset class. To continue on logistic investment, it is clear that this is the most resilient asset class with 1% increase over the year, against minus 34% for office and minus 15% for residential. Moreover, the share of logistic investment in Europe is catching up with that of retail, which now represents 14% of the total. Do you observe the same trend on the financing side?
Yes, Jennifer. Loan volume dedicated to logistics is following the same trend. Loan market is not as transparent as the investment market, but assuming 75% of the transactions are leveraged with debt, and if we apply the average LTV we see in the market, which is about 55%, in 2020, loans provided by banks and NBFIs in Europe should be in the region of 13 billion euros. As per the investment strategy of the asset owners, we see a clear switch since 2017 from local regional portfolios to sizable pan-European ones. This has an impact on the lending market because it clearly gives a competitive advantage to banks with a global footprint and expertise and with skills to structure more complex transactions in different jurisdictions. We see this market evolution as a challenge for the lending industry because of the growing part of the cross-border transactions, and if the investment volume continues to grow at the same pace, local banks will have to adapt their lending policy to accompany this trend.
So logistics is showing real resilience this year, with rather weak impacts from the crisis. How could you explain this resiliency?
We can explain by the fact that this asset class benefits from structural supports. The first one is demographics. Demographics are increasing and becoming more and more concentrated in the cities. This is the challenge of urban logistics, and the offer will have to adapt with a new organization like inner cities logistic hubs, reallocation of spaces, virtualization of flows, etc. Second one are administrative and environmental constraints, which main goal is the reduction of the carbon footprint. Changes will need to be implemented throughout the whole logistics chain, in real estate, for example, with the use of solar panels, but also in the means of transportation with the use of electric and hydrogen vehicles. Third one are changes in consumption patterns, which COVID have clearly accelerated. We know well how e-commerce has grown this year, but it is important to remember that once online sales reaches about 10% of the retail sales, we reach the tipping point, and therefore the supply chain has to adapt to absorb the new flows. Consumers seeking for the possibility to use several sales channels, obliging retailers to invest and adapt their business model, in particular in the mass market retailing, and more specifically, the mass food distribution. And why is that? Because consumers want to consume better and are reallocating their purchase by positioning food as essential. This is why we consider food distribution like the big winner of the crisis, with a push on fresh food supply chain, which needs specific warehouses to comply with the cold chain. The fourth support factor is technology with connected objects and artificial intelligence. Technology helps to have more visibility and traceability across the entire supply chain, and thus accelerate decision-making. It is important to have a resilient supply chain model. Jennifer, what do we need to look at 2021?
To identify countries where there will be the most potential in terms of logistic investment, we need to look at the main logistic hubs in Europe. So let me remind you that the main distribution corridor starts in the Benelux countries and ends up in the northern region of Italy. The transformation of the supply chain and e-commerce, already mentioned, will increase multimodal connectivity, for instance, and will transform and create many other corridors. Namely, we could see up here an Iberian corridor running from Lyon, Marseille, and going from Spain to Portugal, a North Sea corridor linking the port of Hamburg to Copenhagen and Malmö, a central corridor with highway and rail developments, a British corridor after the Brexit more turned towards the national territory. It is important to understand where the original corridor in Europe is located because it will explain a lot of things about yield, rents, and investment. If we have a look at warehouse investment by countries, there is a real investor appetite for warehouses since 2017, with much higher volumes for countries located in the main hub logistics corridors: Netherlands, France, Germany, Austria, and Italy, of course. With the appearance of the new corridors, we see a dynamic of investment which continue in the UK with the development of urban logistics, in the Netherlands as a consequence of post-Brexit, but also in Sweden and Spain with the e-commerce penetration rates approaching 10%. So, in 2021, in Europe, we expect investment volumes in logistic real estate to be identical to those of the last 3 years, with a particular appetite for this market.
And where do we see some value now?
New corridors will support the valuation of logistic real estate in cities such as Barcelona, Lisbon, Prague, and Budapest. And we did a focus on Barcelona because Spain combines several factors: the topping point on online sales, Spain is located in the new corridor, and combines the last mile challenge. That's why we think that Barcelona represents a good potential for the future. Otherwise, Barcelona suffers from a shortage of quality properties that satisfy demand and a shortage of land. So, if we look at prices for core logistics, we see a compression for prime yields between Q3 19 and Q3 20 by 25 basis points at 4.75%, especially in Ring 1, which is very attractive. The vacancy rates are reaching extremely low levels below 2%. Therefore, the demand extends to Ring 2 and Ring 3, resulting in a slight compression of yields and lower vacancy rates in both areas, from 8.5% in Ring 2 to 5%. Among our models, we expect 10% growth potential in capital value in Barcelona at the end of 2022, while we expect only 4 to 5% in Paris, Île-de-France on average. you.